This video is going to be a fun one because I go over many topics, and so you guys can just see my line of thinking. It's also going to be a little bit more conversational, where it's just like you're asking me this question and I'm giving you my thoughts off the top of my head. It's going to be a little closer to like a podcast or that style, and so if that's something that interests you, watch, and if not, I'll see you on the next one. I'm going to go over things like investing with a small amount of money, updates and comments on the 3 ETF portfolio, holding cash during this volatile market, and even touch on options trading. Earlier this week, I asked you guys on my channel to give me a question or topic for a video, and you delivered. I got hundreds of questions and comments, so I picked 5 for this video, and if you have a specific question that you'd like answered, comment down below, and I'll see what I can do. And real quick, one of the questions I got on one of my last videos, you guys saw a tail behind me walking around, and that's my dog Basher. Where'd you go? Come here. There he is. Say hi. All right, no more playing around. Let's get serious. My name is Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. The first question, what would you do if you were a student who has a little extra money, $1,000 to $5,000? How would you distribute between owning ETFs and or single stocks in a regular brokerage or a Roth IRA? The goal for me is to build wealth and get started early so that whenever I'm out of college and get a career, I can start investing 15% of my money. First of all, I love this question. I think that that's awesome that you're already thinking about that, and I know there's a lot of people in this same boat. And so there's a couple things there. The first thing was, if you have about $1,000 to $5,000 to invest, and you called that a small amount of money, but honestly, that's a good amount of money to get started with. And so for me, I really like to get a base of ETFs before investing in any individual stocks. I know individual companies and things like that are very fun and sexy or whatever it may be, and maybe you just want to invest in Nike because that's the brand that you like to wear, or you like to invest in Chipotle because you're currently eating Chipotle. And there's nothing wrong with that, I guess, as long as you do the research. If you only have like $500 or $1,000 to invest in total, you're probably only going to be able to split that between 5 or 6 different companies and get like one stock of each one. And so really at the end of the day, you're not very diversified. And when you get started, you really want to build that base of diversification, and an ETF is going to be your best bet to do that. I really like to get started with ETFs like VOO or VTI. VOO tracks the S&P 500, and VTI tracks the entire US stock market. The S&P 500 or VOO is returned on average over 10% per year with dividends reinvested, and so if you were able to put something like $200 in each month for 30 years, that would add up to almost $400,000. As you get older and further in your career, you're going to have more to invest each month, so you're going to be able to put even more away, and that's going to grow even further. As far as where to put it, in a Roth IRA or a brokerage, honestly, I like to put it in both places. Most people will say max out your Roth first and then do the brokerage, and I see the thinking behind that. I just know that if you're investing very early in life, let's say you're 18, 19, 20, if you're investing and you stay consistent with it, there's a good chance that you'll be able to retire before age 59. And if you want to retire before age 59, you're going to want to be able to take out your money at that time. And so if you're age 45 or something and all you have is everything in the Roth IRA, you can pull out your contributions, but you can't pull out anything that it's grown to, which is the larger amount. So for me, what I would probably tell somebody who's a little bit younger is, yes, build up the Roth. Get maybe 75% of your investable income into that, but put some into the brokerage account. And as you start making more money in your career, you might go more like 50-50, and then eventually it'll be mostly in the brokerage since the Roth has a cap for how much you can put in. Number 2, what do you say to those who say that your new 3-fund portfolio has too much overlap? This answer is important, but just as important is preparing for your family's financial future. So let me thank and introduce the sponsor of this video, Policy Genius. Policy Genius is the country's leading online insurance marketplace. It saves you time and money so you can provide your family with a financial safety net starting today. With kids back in school and summer coming to a close, this is the perfect time to plan for the year ahead. And life insurance is an important way to make sure and protect your family's future. Unfortunately, 41% of people don't have the life insurance coverage they need, and 40% of people with life insurance wish they'd purchased their policies at a younger age, which makes sense because it costs more as you age. What I really like about Policy Genius is how easy it is to navigate, and they're very straightforward with essential information. With Policy Genius, you can find life insurance policies that start at just $292 per year for $1 million of coverage. Some options are 100% online and let you avoid unnecessary medical exams. Policy Genius helps you compare options from top companies, and their team of licensed experts is on hand to help talk you through it. The process is quick and easy, and you can go see your free quote today. Head to policygenius.com/investingsimplified or click the link down in my description to start saving today. All right, so back to that question. What do you say to those who say that your new 3-fund portfolio has too much overlap? And I get this a lot, and honestly, it does have a lot of overlap. Anytime that you're gonna have the 3 ETFs that I choose in these types of categories, they're all large cap ETFs, which means they have large cap companies, and there's only so many of them. And so yes, there's going to be some overlap. My 3 categories are, for the safety section, the value or dividend investing would be SCHD. For the foundational category would be something like the S&P 500 or the total US stock market, so VOO or VTI. And then for growth, the more exciting ones, that's going to be something like QQQM or SCHG or VUG, any of those types that are a little bit more broad but also growth style. Now, the idea with the 3-fund portfolio is not to be the most diversified ever. That's not what we're going for. For some of you, maybe you are. You want to have the absolute most diversification as possible within your portfolio. And that's great. Maybe you should add in some mid-cap companies and some small-cap companies and possibly have bonds and all this other stuff. And that's great. In my investing entire portfolio, I am diversified. I have real estate, physical real estate. I own businesses, so there's my risk there. I also own a little bit of Bitcoin in that cryptocurrency world, and so there's risk there. So for me, I'm happy with these 3 broad, large cap style ETFs, and my ultimate goal is not necessarily just diversification in total, but I am happy with that diversification, to be honest. There's over like 600 or 700 different companies within those 3 ETFs that I'm investing in, and that's enough diversification for me. And I see that in my portfolio. When certain sectors get hit, like how the semiconductor sector got hit and SMH dropped like 10-15%, the S&P 500 only dropped like 2%. And so for me, I'm happy with that diversification because it keeps me safe, but also brings me a bunch of upside. What I care more about is grabbing that upside through the growth ETFs, but also limiting the downside, so holding the value or the SCHD dividend ETF. So I guess that was a long-winded professor-style answer of me just saying, yeah, I would agree that there is some fund overlap and I'm okay with it. Having too much fund overlap is not the enemy. It's just understanding what it means to have fund overlap and understanding that you have it or you don't have it. The thing that would hurt you is if you think you're investing in multiple ways and think you're diversified in these specific ways, but then you find out you're actually investing in the exact same things, and now your risk is all in the same place. I've done a lot of research, a lot of back tests, just a lot of data points, trying to figure out the best and ultimate 3-fund, just very simple portfolio. And this one definitely hits in every box. Yes, it's going to have some fund overlap, but it's doing what it's supposed to do, which is keep me moderately safe while still giving me that upside for growth. Number 3, at what point does it make sense to use a financial advisor that charges a monthly fee compared to a simple do-it-yourself 3 or 4 fund portfolio? This is a great question. Obviously, I'm not big on financial advisors or somebody that's going to take over your portfolio and charge you a fee forever. I do like the idea of financial advisors that are fee-based, somebody that you can pay for like an hourly conversation and they give you some very tactical answers for your specific situation. I think that that's great. And I actually offer that. I do private financial coaching, and my email's down in the description for that. But I definitely am not big on somebody just managing your money for you. Now, for those of you that just say, I don't really care about any of this, I don't even want to learn about it, I don't want to know about it, but I do want to possibly get, more money than the inflation is taking away from my money, then yeah, have a money manager manage your money. They'll get you an 8 to 10% growth. You'll have to pay them a couple percentages, and you make more money than it just sitting in the bank. So yes, that's a good option. But I think that if you're watching this video or any of my videos, you're not in that category. I think that you've learned a little bit, you can do the research, you actually care, and I think that as long as you keep it very simple and keep it very broad with the type of ETFs that I talk about on this channel, you could definitely manage this yourself. What I've found with my clients is that sometimes it's just good and helpful to pay somebody for an hour just to make sure you're on the right track, just to talk through some things, because you're likely not talking about money with your family or maybe even your friends, just because it's a touchy subject sometimes. So with someone like myself, we can just run through your situation, look at how you're doing, and at the end of the day, if all I say is, yeah, you're doing amazing, that'll give you peace of mind and it'll be well worth it. Number 4, should I be holding lots of cash right now? That's a really good question, and really I'm gonna go back and ask you a question. How do you feel right now? Do you feel safe? If you don't feel safe because you see the market going down some days and then it comes back up and then it goes down and you see your money going all over the place and being very volatile, if that's keeping you up at night, my thought right off the bat is that you might have too much invested and not enough off to the side for you to have some safety. There's probably a reason why you're feeling uneasy about things. And it might be that you have too much invested of money that you actually might need in the near future. If you're investing with money that you need in the near future and it goes down, that's gonna produce a lot of emotion and that's gonna make it so that you feel uneasy about investing. That's why I always recommend that you have an emergency savings. Try to hit 3 to 6 months worth of living expenses sitting off to the side outside of the stock market. Now, I know this question is more about, should I be holding cash off to the side, specifically with the goal that when the market drops, then I throw the money in? And that's a different question. For me personally, I do think that the stock market will drop. I don't know how much, I just think that there's a possibility that a lot of these numbers that keep coming in, or the Fed rates and the job claims and all these things, again, with the presidential election all together, I do think that's somewhat of a ticking time bomb, and there's a possibility that we drop 10 or 15%. Those of you that have money off to the side, even a little bit, throwing money at that point at the bottom is only going to be a good move. So should you be holding lots of cash outside of the market? My personal opinion is no, and I'm not doing that. I'm not selling any of my stocks or my ETFs right now with the idea that it's going to drop and so then I'll buy back in. That doesn't really ever pan out for people, unless you just get very lucky. What I'm doing is continuing to dollar cost average, but I'm putting a little bit in a high yield savings account, like 10% or less of my investable amount each month. And eventually, 6 months from now, if the stock market hasn't dropped a bunch, I'm just gonna throw all that in that day. But if it does drop 10, 15%, then I'll use that cash and buy in, and hopefully it'll go up a lot more and make a lot of money. Number 5, do you believe options trading can generate money faster than value investing? Yeah. I do think that it could generate money much faster than value investing. It could also lose you money way faster than value investing. Options trading is basically betting. It's high-level gambling, it's educationally gambling to a certain extent, and some people think they have it figured out. But the problem is that I hear more people lose all of their money than that people gained a bunch of money. What you're basically betting on is that a certain stock is gonna go above a certain price, or a certain stock is gonna go below a certain price, and you're hoping that it doesn't do that based off of certain charts and certain patterns and things like that. And so that's more close to gambling than investing. When you're investing, you're putting money into a company knowing that they're going to use that money to increase their competitive advantage or increase their value, and by doing so, your investment will be worth more. Value investing is a slow and steady way to make a lot of money. There's a guy by the name of Warren Buffett who's done a pretty good job of making a lot of money using value investing. Slow and steady does win the race in investing, and that's kind of what a lot of my channel is about. It's a little bit boring, it's not really that much fun to watch an ETF, but long term, the data doesn't lie. It's a great way to build wealth, and most of the world's millionaires get wealthy that way. Check out either of these videos to keep you going strong in this investing journey, and I'll see you on the next one.